Okay, welcome to today's meeting. So today, what we'll be discussing is what we call how we understand a range, how a range can be defined. So, firstly, so that you can understand what we call inducement. Firstly, in a range, we have what we call primary and secondary range. We have what we call primary and secondary range. So primary means the initial area of a move. Secondary means that is an area that support the formal move in trading. Now, apart from the normal definition of primary and secondary moves or those stuff. So now, what do you mean by primary zones or primary range or secondary range? Now let's take, for example, this is a structure range. A structure range, what I mean by structure range, from this low, this new low that was formed, to this recent high that was formed, is what we call a range. So let's check, for example, we're in a downtrend. This is our external liquidity. External liquidity or structure, external liquidity. Major structure slash liquidity. That's major liquidity or major structure. So what we mean by major structure, a high that we're not expecting market to read. Same thing. I'll be going over that for and over again. So like we said, our main priority is for us to always look for where to join to take out what an external liquidity. Now, we will explain how to be you a swing trader or a day trader or a scalper. We will explain when to expect a swing trade and when to scalp and when to wait for price. We'll explain all. So because it's not all time that you take swing trade. Well, it's cool. You take swing trade all time. Sure. You take swing trade, you take scalping all time. But there are some areas whereby momentum moves are more. Now let's take, for example, there are some places whereby let's say this is happening on monthly time frame or on weekly time frame. Now there are some places, this is weekly low. This low is weekly low. This low is weekly low. Now, there are some places or there are some times market can read this weekly low from here within just a week. If this is a week, if this happens within a week, why should you, even if you're a scalper, it's not bad that you hold this trade as a scalper from this area, entering at this area, as a scalper entering around this area, holding this trade from here up to this level, where you know that this is what market will do. Why should you be breaking even or why should you be taking profit around this area when you know that market will not give you another entry? Or why should you be taking entry or taking your TP around this area when you know that market will not give you another entry to join the next day? It's not that it will not give you entry, it will be giving you entry, but those entry, before you come back online, market is already dropping more than from where you take a break even before the next day, market is already dropping more than 100 pips. The entry that you are waiting to take, you have already missed it. So there are some times market give what we call a long run, a long run. There are some places we expect that, and there are some places we expect market to give you a consolidation. So this area where market is giving consolidation without good momentum move, this is more favorable to scalpers, or when market is trapped within a range. When market is trapped within a range, this is more favorable for what? For scalpers to take. When market do this, you will understand when market is doing this, you understand that market gave multiple entries for scalpers. It gives buy, it gives sell, it gives buy, it gives sell, it gives buy, give sell, you give buy, on sell, buy, sell, buy, sell, buy, sell, buy, sell. Let's say this is happening on daily time frame or on H1. It's giving multiple entries daily. This is more favorable to scalpers or to intraday traders than swing traders. Why? Because around all this area, as market is giving all this move, they are always in the market. They are seeing entries and taking profit always. But if let's take for example, swing traders, they take this entry, they neglect this buy, they take this, then they miss one here, they take this, they miss one here, they take this. This is the only entry they take. Now you will notice that these swing traders, it will be hard for them to be taking loss trade more than scalpers or intraday traders. So if they take this trade, let's say among the whole trade they took on this 1 hour time frame to take out this external liquidity, they got four entries to take out this low. They got 4 entries. Among the 4 entries that they got, one hit break even. One hit break even. Then 2 are perfect. Then 1, because they did not enter on time, let's say they enter around this area. Market run into profit, get to this area, give a little buy. So market come, take them out, then continue selling. So let's say they take a loss here. They take 1 break even because of this one. Let's say they take entry here. This one almost take this high. So it came back for valid RTO. So market take them out, hit break even here. But they are still holding this before taking out this low. So you will notice that they only got 1 loss. But if a scalper, now you take a buy here, a sell here, a buy here, a buy here. So from here to this area, you took up to 20 trades here. Now, out of those 20 trades that you took, you got break even 4 break even out of the 20. So it's left with now 16. Out of the 16, you took let's say 3 stop loss hit. 3 stop loss hit. Then the rest, you won the rest. Especially when your psychology is intact, you won the rest. This is also good. But for a swing trader that enter here, now on this trade, a swing trader that enter here, a scalper enter here, scalper get to this area, it take profit just for a day trading or within, let's say, London session. Now, after taking profit, price continues selling with mad momentum without special entry. Now, scalper did not see another entry to join. Maybe he was trying to like scalp later based on point of interest. Scalp later, he already knew take profit. It's not giving him more than 1:3, or it's not giving him more than 1:5. There are 10 pips highest. Let's say stop loss is 2 pips. 10 pips. Those are not a good profit. So there are sometimes when market provide a high probability trade, even if it's for what? It's for swing trader and we scalper. There are sometimes you have to have that patience to go do trade. So we explain all. Now the first thing, the first thing we explain now. Okay. Now, like I was saying, I said if this is a lower low, a lower high, a lower low. So this is the range we are trading. From this low to this high. This is the range we are trading. So since this is the range we are trading, now around this area, there's internal structure. There's internal structure. There's what? Internal structure. So internal structure, the last mitigation of internal structure, the last mitigation of internal structure. Now you can notice, let's say around this area, this one is the last mitigation of internal structure. This is the last mitigation of internal structure. This is also internal structure. This range high here, this range low, this range low here, to this range high. It's internal structure, but it did not mitigate this former zone. It did not mitigate this former zone. So that means from this low to this high is what we call liquidity. Market can use it as what? Liquidity. Market can do something like this here. Let's say create a little lower low, then create a lower low from here. So this is normal understanding of internal structure. Of what internal structure? That means what we call internal structure is structure within the range. Structure within the range. That is what our internal structure. So you have to understand the pure understanding of mitigation. If it gives a deep wave into this range, that means it's what we call a mitigation. So if it didn't, then we do consider it as what? Liquidity. We do consider it as liquidity. Now, where market gives the first sign that it will buy here, and when it gives the first sign that it will sell here, is what we call primary and secondary zone. Now, if market gives the first sign that it will sell here, let's say higher high, higher low, a higher high, a lower low here. So this is where we have as minor break of structure in terms of range structure or internal structure. So if this area is where market gives us a minor structure, from this range high to this range low, this area, the range high to this range low, is what we'll consider as primary zone. This is what we call primary area. So this is what we consider as primary area. Why where market gives us the first break of structure here? Let's take, for example, market was on downtrend, making lower, low, high, lower, low, high, lower, low, high around this area with pure mitigation and all. So it gave us here as a minor BMS. From this area where it gave us this first minor BMS to this low is what we call secondary zone. Now, from this secondary zone and primary zone, that's where we will explain what we call point of interest, how to look for point of interest. Primary point of interest, second point of interest, when to expect market to use secondary point of interest and primary point of interest. So this area is what we call secondary zone. Why this is what we call primary zone. Now, the last mitigation, note clearly, note what I'm saying here. The last mitigation here, the last mitigation here is also called secondary mitigation, secondary zone. Is either because sometimes here, this secondary zone here, this internal structure here, sometimes market can decide to break all this area with momentum, or you only see one candle or 3 candles here without using internal structure. So that means this will be what secondary zone. But if there is internal structure, you will overlook what is here and use the word internal structure as your secondary zone. So market can decide to use this internal structure to make a lower low to continue structure. This is what you have to understand. Market can use this internal structure to give a lower low. So if market will not use this internal structure, let's take, for example, it break this last mitigation. Here, it break this high. This is minor BMS to the upside. So that once it gives this minor BMS, and the order flow is still to the downside. The order flow of price, that means the movement of price based on higher time frame, is still to the downside. And you're expecting now market to give you RTO to either the swing high of this area, like just like support and resistance, or give RTO to SC candle, which we know this now before going to this area to our primary zone before giving us another sell. Our primary zone is not only SC candle. Market can test area below this primary zone and sell off. It's not compulsory that only SC, that means sponsored candle is only our primary zone. No. Market can test this area and drop, although there is a reason why it will drop from that area. So when market is ready to use SC, we explain it. When it will use other zones, we will explain it. So we have what we call primary and secondary zone. We have what we call primary and secondary zone. So these are the things you have to understand. We have market can decide to create something like this. Now let's take, for example, a lower low, a lower high, a lower low. Let's say internal structure here is this. Create a little range structure. Create something like this. Market can do something like this. So when market do something like this, when you see this, that means it used what? Internal structure to create a lower low. To create a lower low. It's internal structure that it used, but the idea of what it used here is that the same, that internal structure is what also part of what we call secondary zone. So if there's no internal structure here, you don't see any of this thing here. So that means there's nothing like internal structure here. Then let's say there's imbalance, liquidity void here. That means seller's power is only here. You can't see buyer's power. So market can easily use something here, and you did not notice what market used here to hold price. You did not notice what market used to hold price here. You can be saying it's imbalance. The imbalance is quite too big. Yeah, how will you trade that? There's what we call secondary zone of what price used here to give us the drop. There's what we call secondary zone to give us the drop move. So that is how we range, or that is how we frame our area of interest. We always have what we call primary and secondary zone. So this primary and secondary zone is what defines our structure. So this is what helps us to have more understanding of structure, so that we know what we are trading, so that we know what we are trading. So that is that. And you should also know market can now, good, let's not forget. Now market can form this, a higher high, higher low, a higher high, range structure, range structure. From range structure, it creates another range structure. So as it's creating, if you give a BMS, your next agenda of where you are selling to is this former range structure. Is this former range structure? Before you wait for what confirmation, or when we be teaching about liquidity, before you wait for what confirmation around this area, before you look for buy again, it can continue this range structure till it get to what one particular level or liquidity area before it will give a deep corrective wave. Then I'm creating a higher high. So if market is using a range structure, that means range structure is forming a range structure. That means from range structure, another range structure is what developed or created. Market can decide to do that. You trade what you see, not what you are thinking. So that is the full idea of how market do form structure. Of how market do form structure. So if market forms something like this now here, if market forms something like this here, it gives a little minor BMS. A little minor BMS, a lower low into this former range, create a higher high, boom, a momentum move because it has gotten to a valid area of what concentration whereby we can look for sell. But for now, we don't know. But it gets to one particular level and give us a momentum move to the downside. Now, people are saying they have gotten what a BMS to the downside. They are looking for what to sell. Market will come, eat them. Market will give them a fake hook later around this area. After that fake hook, it will eat them out of the market. It will give them that fake hook. So you have to understand what you are trading. So as market did that, the same process. Now it can decide to do this something like this again. You know, This area is where it gives this little minor BMS here. Higher high, higher low, a higher high, a lower low, then a higher high, then a lower low. You see what it formed here? It first formed kind of, sometimes you can see what it formed here as a trend line touch, as a trend line touch. So just to trap trend line into trading, or you can use something like this. Sometimes a little forced breakout of trend line touch, boom. After trapping them out, they will be looking to buy because it has given them a breakout of trend line. So they will be looking to buy. The market will go against them. So that is that. But that does not mean that retail traders don't know what they're doing. Apart from those ones that are novice, there are some retail traders that use trend line and also kill the market. You should know that. You should know that. It just depends on your level of understanding. It's just the same thing with SMC traders. There are some areas where order block can be used as trap move. Where order block can be used as trap what? Move. So people will set their stop loss below order block. Market will come to that very particular order block, read it with 1 pips or 2 pips. Though you won't notice that it read it late more. Though some of them will be calling it fake BMS. It's not fake, it's just liquidity. It's just liquidity the market did there. It can read this low if this low is not a strong low, according to what we are learning. If this low is not a strong low, and this low is against liquidity. So if this low is against liquidity, market will read it with either 1 pips or 2 pips, then start buying. So that's why sometimes you can see something market forming double bottom. You have to understand that there's a reason why market is forming those double bottom. You can trade those double bottom. When market will form it, you will know that market will form it. You will even set your limit order below this low, few pips below this low, either 1 pips or 2 pips below this low, because you know that this low is the low it will read before it buy. Market people will be calling it double bottom. The market will come and read it, but you're already done. Before market will come and start seeking for that, start seeking for this double bottom here, you are already done. It has already taken out external liquidity. So those are the things you have to understand. Those are the things that you have to understand. So like I was saying, now we have 2 zones. We have 2 zones in every range. In every range. Now let's take, for example, on this British pounds. Now on this pair, you understand that the flow of price on this pair is downtrend. Is downtrend. Flow of price is downtrend. So since flow of price is downtrend, though price is already losing momentum, that means sellers are becoming weak. This is where we use momentum. When you can't see anything on the left-hand side, when something like this left-hand side is blank. So if market is about to start reversing, it will be losing momentum. That means change of hand will be what display. The sellers, the kind of candle that we were given before will be reducing. The kind of candle they were given before will be reducing. You'll be seeing more consolidation. So consolidation is already coming in the market little by little to show that sellers are becoming weak, but that they're not yet weak. When market do this, that means it's already approaching a point of interest on the left-hand side. When it's becoming weak, it's already approaching what? A point of interest at what? The left-hand side. But we can't see anything here. That does not mean we can't trade it or we won't understand what we do. So you have to understand your range. So from this, you will understand that now, from this time frame, this is where we have a BMS, a break of structure to the downside. This is the range, structure range. This last lower low to this recent higher high. On this 3 months time frame, this is our structure range. This is what we call structure range. From this low to this high is what we call structure range. This is what we call structure range. So that is the full definition of structure range. It's not range structure. Range structure is different from structure range. So that is that. So from this structure range, where market give us first BMS. Now let's go to weekly. Where market give us first BMS, higher high, higher low, higher high. Look at it, a higher high, a higher low in terms of minor structure, in terms of a little range structure from this area. In terms of structure, little structure around this area. Now this is where market give us what? The first BMS. So this means this area from this very high to this area is our primary zone. Why? Since market took this low, where market give us the first BMS, where market give the sign that it provide here. From this area, this low to this area is what we call secondary zone. So this is how we define zone. This is how we define zone. So you will notice that this secondary zone, forget about refinements, was the one that was able to at least to create a little lower low. To create a little lower low. But we are still on downtrend. If you check it closely, we are still on downtrend. We are still on downtrend. So here, this secondary zone was able to create what? A lower low. This secondary zone was able to create a lower low. So that is what we call secondary zone and primary zone. So this is only SC cannot answer primary zone. Only if you know about support and resistance cannot answer secondary zone. If you know about breaker, that only cannot answer secondary zone. So there are some criteria that we use in defining what secondary zone. So when you have the first BMS, when market is about to give us this piping, we call that area secondary zone. When market give us the first sign it will sell, we call that area primary zone. We call that area primary zone. That is the full definition of a primary zone. Now, if you notice that, you will notice that this high here was rated with little pips. This high here was rated with little pips. So some people will say that this is the what price used here. This candle here is what price used here for this sell. Like this is what price used here. Now let's use monthly. They'll say that this is what price used here. This candle or this SC. Or anything you call it SC or other block or supply and demand zone. Other block is the same as SC. So some people will say that this is what price used here. But price rated that candle here with little pips. So if you set your stop loss above it, you are out of the market. Market already rated that very high before selling off. So those are the ideas of liquidity. So if you know that this high will be rated with short P, then your point of interest or your zone of interest that market will not read. You know that market will not read this one. It will not read this one. So from this area, this short high, from this short high, let's say from here to here is your point of interest from higher time frame, apart from refinements. From higher time frame, apart from refinements. So these are the ideas of what liquidity. These are the ideas of liquidity and primary point of interest. So from this area
Market always have either primary or secondary, where market gives the first BMS. So here now, it use secondary, it starts selling, continue selling, without coming for LC candle, secondary zone, where it gives first BMS on, let's say, weekly time, monthly time frame. It's your primary zone. Here it use secondary. Same process, secondary or primary, secondary or primary, secondary or primary, secondary or primary. So price will form liquidity to define the one it would use. It all zone built on M1, built on what M1. Okay, this broker has a lot of noise on M1. Now, if you take it from here, all zone have either primary or secondary zone. All zone either have either primary or secondary zone. So looking at it from this time frame, now look at it from this time frame, you understand that now from here, this is M1, a lower low, a lower high, structure within the zone. This one here, this low is within this main structure. So now after market broke that low, you understand what we call mitigation. Well, mitigation. Lower low, lower high, lower low, lower high, lower low, lower high. This is where mitigation stops. So this is where mitigation stops. Then it creates a little imbalance below this one. After breaking this one, it kind of use support on resistance. So this is where market stop mitigating zone. This is where market stop mitigating zone. So that is why market now came to this area, boom, before giving us a sell move. Before giving us what? A sell move. Now to target this low based on the time frame you are trading. Based on the time frame that you are trading. Based on what? The time frame that you are trading. So it gets to that very particular SC sponsored candle within this internal structure. Internal structure before breaking out this external structure. Internal structure has also internal structure. This area acted at now as what? Liquidity. We first use this now. Look at it so that you'll be understanding what we are dealing with. I know that there are some little things that will still like kind of confuse you. Now, I know that there are some little things. This area, internal structure here, was able to create a lower low, a lower high. It creates a lower low. Instantly, it creates a lower low, it creates a higher high, BMS. A BMS. Now, as you give this BMS, now we'll be explaining it gradually. As you give this BMS, now there'll be a time you will understand that this buy will happen. You will understand that this buy will happen. Your target is this high. Your target is this very high. Your target is very high as your TP. Though it's on M1, if it's on higher time frame, the same thing. You know price is fracture. Why your stop loss is below this low. So why your stop loss is below this low. And already before that, you already know that this sell will also happen. So you're able to catch this. You're able to catch this again. Though the risk reward ratio is quite big. But if you're able to refine it on lower time frame, to have shorter stop loss. Let's say you have 1 pip stop loss or 0.8 stop loss here. This will give you a little bit 1:9. Good. It's also good if you know what you're doing. So, but I'm not saying that you should be scalping like this. So if you know that this major move will happen, it's better you take this type of move. Sorry. It's better you take this type of move. You take this type of move. You take this type of sell move. You target this very low. Even as a scalper, target this area as your TP. If this is what you catch, this is better than trying to catch all these things that you see. And don't be distracted easily as a trader. But if you are distracted, you have confidence in yourself. Believe me, as a trader. And if you don't have confidence in yourself, you can never be profitable. So that's what I always tell my students. There will be a time when we are done with liquidity, some of the group that you are will be it my own group. You will leave those groups. You will leave those groups to be building your own psychology level and confidence on yourself. So when you have built confidence on yourself, even if you come back to the group, even the trade that I will share will not distract your own analysis. So those are the things you have to build as a trader. Those are the things you have to understand. So those are the things. So once you know that this thing will happen like this, if it's happening on higher time frame, now you know that instantly markets take this high, you will look for sell. Instantly take this high, you look for sell. Why your stop loss is above this high? Why your stop loss is above this high? Then your take profit is below this low. So even if this is what you catch again, 1:8, and this is also good. There'll be a time you understand all this. So you have to understand what market is doing within those mitigation, internal structure, and our primary and secondary levels. Now, this is second time frame. Where market give the first sign that it will sell after taking that high was this area. That means what market use here is, this is primary. Market did not come back to primary yet. Why? Where market give us sign that it will buy is this. That means this is your what? Secondary area. So this secondary area, because there's internal structure here, you won't care about secondary again. What you use is the internal structure. But if there's no internal structure here, that means it forms, let's say, for example, you see one big candle here, one seller's candle here. Again, there's nothing like internal structure or mitigation of all the things that you're seeing here. This low, and there's nothing there. You won't care about this imbalance that is here again. Because for me, I don't trade liquidity void. I trade imbalance. But liquidity void is different from imbalance. We already explained that. I don't trade imbalance. I don't trade the liquidity void, I want to say. I trade imbalance. So now if market form this, that means you have what we call liquidity void here. So since market gives us this liquidity void, we're expecting market now to come and do something here. So people will not see what it used to create this low and continue selling before giving a deep retracement. So people will not see what market used to continue selling here. But that is the idea of what our primary or secondary zone. So those are the things you'll understand for today's class. So that is that about that. So what market did here now, these two high, this and this. Now let me do like this first. Now this and this, because they did not mitigate this former zone well, especially when market use support on resistance, those are what we call unmitigated, or it creates imbalance. Those are what we call unmitigated. When it creates imbalance, or when it creates support on resistance, it uses support on resistance. Those are what we call unmitigated areas. So when it creates this unmitigated, as price is ready to buy, two of them are acting as what? Liquidity. Two of them are acting as liquidity. So market read them. After reading them, it have to obey the rule of market structure here and liquidity. So as market is selling down here, you know that it will read this low. So below this low to this low is your point of interest. Then maybe between it, you go to lower time frame, 15 seconds, but this is quite still low. I'm just trying to use it to explain. I'm not saying that you should be going to lower time frame to be hunting for setup. No. So within this low, now market can use it now to what? Give us what? A short buy to target the next high, and which you know it will take this high. So since it takes this high as a higher high, your stop loss is below this low. So once it is able to take out this high, Now you are already in. And some of these entries, they don't give instant execution entry. So some of them are made for what? Limit orders. Some of them are made for what? Limit orders. So when you know that it will form, you set your what? Your limit order above the other high, either by 1 pips or 2 pips. Though you should know that there are sometimes you mix trade by either 1 pipette or thereabouts. You will surely miss trade. That is sure. Even if no matter how advanced you are, there will be a time you miss trade, whereby you were waiting for price to what? Your limit order is around this area, market get to this area. But one thing is this, the liquidity market will take, it must surely what? Take it. It's only your what? Let's say little mistake about point of interest that will make you to miss trade sometimes. So that is just it. That is just what you have to watch, understand. So that is that for today's class. So our major focus for today's class was primary zone and secondary zone, so that we use it to explain liquidity in our next class. So that is that. See you next class. Good luck. Good trading.